Hi everyone, we're going to review problem 932A as our chapter 9 part 2's problem. In this chapter, part of the chapter, we're looking at notes receivables. Now, as discussed in the lecture, notes receivables are when the company essentially loans money to another company or a person, and it's a more formal written promissory note that not only will they receive their money back at a maturity date, but also interest calculated at a certain interest rate. So the first part of the problem, we want to identify two major parts of a note receivable, and that is maturity date, when will the loan be paid back, and then the maturity value, the principal plus interest that will be paid back. Now, if you're sitting there going, well, that's not usually how I pay on a loan. Usually I have to pay monthly payments. Well, in the real world, that's normally how we do it. But the interest calculation on that kind of a loan could become complex. And that's not the purpose of this exercise in our beginning accounting course. It is just to indicate that we do calculate interest, but we're doing it more on what we call a simple interest method. So the assumption is that we loan money out one day and we receive all of the money we loaned, plus the interest earned on that loan at a future date. Now, our first note has a one-year term, and it was taken on April 1st, 2018. So we will receive the money back on the maturity date of April 1st, 2019, 1 year. So when the term is indicated as a year, we just add a year. In the second note, the term is indicated as 6 months. So we say, okay, today is September 30th. 6 months from September 30th is March 30th, 2019. The final note is listed in terms of days. So you just don't add 3 months to September 19th. You actually have to find the 90th day from September 19th. So what you need to do is start with your months and say, okay, how many days are there in September? 30. So the 30th of September is the 11th day from September 19th. October, there's 31 days. So October 31st is the 42nd day from September 19th. You would add 31. We need the 90th, so we're still way off. We still have 30 days in November. So the 30th of November would be the 72nd day from September 19th. We need to know the 90th day. We need 18 more days. So December 18th would be the 90th day and the maturity date when the loan is a term of days. So if it's listed in terms of years, just add the years. Months, find the months from the day the loan is taken. And then days, calculate actual days. So that's our first hurdle. The second is calculating interest. Interest is calculated on a formula. Principal of the loan times the interest rate times the interest period. Now, interest rate is always stated in annual terms. Always. That is always a 12-month interest rate. It doesn't matter what the term of your loan is. It could say it's a 6-month loan, but the interest rate will calculate 12 months. So for note 1, $6,000 principal, 7% interest rate times 1 year is the term. So 12 over 12. So we would calculate a whole year's worth of interest on a 1-year loan, $420. $6,000 principal times 420 interest revenue earned, $6,420 is the maturity value. On note 2, now let's take a look here. $12,000 is your principal. 6% interest will give you 12 months worth of interest. We only want to calculate 6 of 12 months, or $360. So add that to our principal. $12,360 is the maturity value. Finally, on note 3, we will take the principal of $18,000. 8% is an annual interest rate. Our term is in days. So that 8% is, if we had to calculate interest for 365 days. We don't. We only need to calculate for 90 of 365. So we multiply it by the fraction 90 over 365 days. That will give us interest revenue of $355. So add that to the principal. We will be receiving back on December 18th, 2018, $18,355. So that's how we do the calculations for determining maturity date and maturity value. Now, how do we create the journal entries? Well, you can see right in front of you there that when a note is created, the company, Harley Realty, that's us, we debit note receivable for the principal only, because on the day we loan the money, that's all that occurred. We gave $6,000 on April 1st. Debit note receivable, which is an asset, credit cash. September 30th's note, which is note 2, debit note receivable, credit cash for the principal. And you would do the same thing with the September 19th loan. Debit notes receivable, credit cash. Now, the third loan matures in December. So that will be our next transaction related to this loan. How much will we receive on December 18th? Cash of maturity value, $18,355. We will credit the note receivable for the principal amount of $18,000. And since this note started and ended in the same accounting year, all the interest revenue was earned in this accounting year, so we will credit interest revenue for the total interest on the loan. Now, we can't say the same is true for Note 1 and 2. Note 1 begins in the 2018 accounting year, but ends in the 2019 accounting year. And over those 12 months, interest is being earned on that loan. So interest revenue occurs in 2018 and 2019. Same with Note 2. It was created on September 30th. Interest started accruing on that during 2018, but it won't mature until March 30th, 2019. So there's some interest revenue accruing in 2019. Remember what we say about revenue. We record it not when we collect it, but in the accounting year it is earned. So what we need to do for Note 1 and 2, since interest revenue happens in 2018 and 2019, is on December 31st, calculate how much interest revenue occurs on each of the loan from the day it started through December 31st. So our first loan began on April 1st. April, May, June, July, August, September, October, November, and December. So 9 months of interest revenue has accrued on this loan by December 31st. It's revenue in 2018. $6,000 is our principal times the interest rate of 7% times 9/12. $315 of the total interest we calculated on this loan of $420 occurs in 2018. Note 2 will do the same thing. $12,000 principal times 6% interest rate. How many months of interest have occurred from the day the loan began through December 31st? October, November, and December. So 3/12 or $180. So we add those two amounts together and we credit interest revenue on December 31st. Since we're not receiving the cash related to that interest until next year when the loan matures, we debit interest receivable until the day we get the cash back. So this is an accrued revenue. Taking you back to Chapter 3 and adjusting entries. A revenue that's occurred, it's been earned, but it hasn't been recorded yet and we haven't collected it. And interest revenue is a common accrued revenue. So let's see what happens when these loans mature. The first loan matures, well, this is actually note 2, on March 30th. I'm just going to scroll back up here. Here is our detailed information about the March 30th maturity date. The company is going to receive a total of $12,360 when the note matures. There it is. Cash, $12,360. They're going to credit note receivable for the principal of $12,000. They're going to credit the interest receivable for the interest that was recognized last year as revenue. We're getting that money now. Then we need to calculate the amount of interest that's occurred from January 1, 2019 through March 30th. And that much of the interest is revenue that we record now. $12,000 principal, 6% interest rate times 3/12. So part of the interest was recognized as revenue last year. Part of it is recognized this year. The same with the April 1st loan maturity date. Take a look back up here. Here it is. This first loan matures at a maturity value of $6,420 on April 1st, 2019. So we'll be debiting cash for the $6,420. Credit note receivable for the principal. Got to reduce it for the principal because that's what we recorded it at. The part of the interest we recognized as revenue last year and is sitting as a debit in interest receivable, right in here, guys. Here it is right here, the $315, we credit interest receivable for. Then we calculate the amount of interest revenue that has occurred during 2019. From January 1 through April 1st, which is 3 months, January, February, and March. So $6,000 principal times 7% interest rate times 3/12. So we credit interest revenue for the remaining interest that's been earned during 2019. So that is how notes receivables work. The key items are recording them at their inception date, accruing any interest revenue that may need to be at the end of the year, and the collection of the money on the maturity date. So that ends our review of problem 932A. Please post any questions you may have on the discussion board.